Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from our website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 40 in our series for 2024, and today's date is Friday, November the 1st. First, I'll be talking to Michelle May, principal from Michelle May Buyers Agents. We'll talk about how to be on the ground with buyers and why there is an emotional connection with property. And I'll be talking to Rabobank economist Michael Every about the latest with the Chinese economy and what impact will the US election have on China. But first, let's talk to Michelle May. Michelle, how did you become a prize buyer's agent in Sydney?
Oh, I like the word prized. I bought my first property at the age of 22 when I was working in the UK, and I won it actually on sealed bids on £50 at the time, which was incredible. The agent sort of helped me out and said, "Oh, if you just do an odd number." And I bought this place, and it was in a really bad state, and I did it up as best as I could, and I sold it within a year. And then I thought, oh, I had a normal job, but I really enjoyed doing this in my spare time. And so I started doing one a year, did that for 12 years, and was obsessed with the show Location, which ran in the UK for, I think it still runs to this day. And then when I moved to Australia, 2 kids in tow, wanted to get back into the workforce and thought, what actually do I want to do? What am I passionate about? And so I knocked on the door of the president of the Buyers Association of Australia at the time, who happened to be in Brisbane, and said, "Can I have a job, please?" And they took me on as an apprentice. And for a year, I just learned, absorbed, wasn't allowed to talk to anybody, but just learned, the skills that you need to be a buyer's agent. Worked for them for a period of time, then moved to Sydney, worked for other agencies. And 5 years ago, I decided, okay, I think I'm comfortable enough. I know enough to go out on my own. And so here I am now.
I mean, you have something like an 80% success rate with auctions, is that right?
Yeah, I mean, it does fluctuate, but definitely, I think we're even higher at the moment, actually. But yes, I think going into auction, people just think, oh, just assume the person with the most money will get the job done. And there is a certain truth to that, but I do think going in with an action plan will actually serve you very well, and hiring someone like me who is not emotionally involved and who does this almost every weekend, multiple times, per weekend, year in, year out, I can certainly teach my clients a thing or two, I think.
Well, I mean, it seems to be the industry seems to be 24/7, not 9 to 5.
Yeah, I don't really have a life. But that's a good thing, because I love what I do. I genuinely wake up every day and look forward to what I get to do. I generally get one day off a week, but even then, if needs must, we work on Sundays and get the job done, so to speak. And there's more and more sales agents who are now actually opening up properties on Sundays and doing auctions on Sundays, because buyers are free that day. There's no sports generally and no work, so they're meeting the market. So as buyers agents, obviously we've got to respond to that as well.
I'm quite intrigued by how you on the ground with buyers. I mean, is there an emotional layer to property?
Oh, absolutely. There's no doubt about it. We obviously work predominantly with homeowners, first home buyers, people on to the second, third, fourth rung of the ladder. We do work with investors, but mainly with owner occupiers. And sometimes we joke in the office and say, look, we're part buyer's agent, part psychologists / marriage counselors, because there is a reason why people are more and more reaching out to buyer's agents like us, because they realize actually it's not just a simple transaction. It's not just like walking into a Volkswagen dealership and going, okay, I'm going to have that one. And funnily enough, it turns out that people actually do more research in what kind of car they're going to buy than what type of property they're going to buy, right? So we can really break it down and also tell them some hard truths. We sort of cut through the wishful thinking, the the bad advice they've received from the hairdresser's cousin, brother, sister, and also obviously all the headlines in the media as well. So because the industry, the property market is not one market. It's many micro markets. And unless you understand what's going on in a particular suburb, in a particular type of property at the time, you could be wasting a lot of time chasing the property that you were never successfully going to buy in the first place.
This is fascinating. This is really fascinating because I kind of wondered about this, that you would actually help clients negotiate a purchase?
Absolutely. It depends. So buyer's agents usually offer a number of different types of services. So we could just be the hired gun on the day. You give me your budget, I show up at the property, and I like I said, I use my strategies and bid on your behalf. All the way through to a fully comprehensive service where we sit down with you. If there's a partner involved, we sit down and really break down your needs and wants list. And then we sort of project manage that from there. We take you by the hand and go, okay, let's go. So we search and shortlist off-market properties, what's on the market, we inspect, we evaluate, we do a lot of due diligence. It can range from, infrastructure projects, walking away from, properties that are in potentially compromised locations. We review building and pests. We do a really thorough review of strata reports because, there's a lot of information to be had in there. We coordinate all the various parties involved. We talk to your broker. We talk to your solicitor. We can put you in touch with the right people as well because, again, if you've never bought before and you're recommended a, say, broker or a solicitor by some friend who's only ever bought one property before, how do you really know that they're actually really good at what they do, right? So because we know so many people in the industry, we know who is good and who's kind of mediocre, So, and particularly in a fast-moving market, it is really important that you are working with the right people and that you're not being led up the garden path. And so, so that takes us all the way through to an auction or negotiations, and then we keep working until we purchase for you.
Now, I'm sort of wondering about property and prices. I mean, the industry seems to fluctuate so much, day to day. I notice.
Yes.
And it's so dependent on so many different things. How do you manage that?
It's a never-ending learning curve. I can tell you that. So I've been a buyer's agent since 2008, and I've been through many different kinds of markets. But then, of course, COVID comes along, and you go, "Oh my gosh, what do we do now?" So that again taught us a lot of things. It allowed us to really evolve as buyer's agents and really take it to the next level to help a client buy still in really difficult circumstances. And then, of course, the market turned extremely hot. So, I think ultimately it is about understanding property as what you've got in front of you. So every property is different. Every property has a different value to it in the sense that, its capital growth potential, for example, so just because it meets a client's needs, but it's in a terrible location, we would actually say, well, listen, this house might suit your needs, but do be aware that if you take that next step on the property ladder, this property is the kind of property that will drop the first in value and also in buyer demand. So you could be left sitting there and getting capital growth, but it'll be under the median. So you'll actually have less money to play with come your next step, so there's opportunity cost there. So it's about providing context for the client. I don't chase media headlines. I think that, particularly within that 10K radius of the CBD, quality property will always have that underlying demand, and particularly when we talk about houses versus apartments. And I think people saw that by and large during COVID as well, how the apartment market really, the demand dropped significantly because obviously there was a certain demographic that was no longer interested because the borders closed, but also because there's a much larger supply of apartments in general. So within that 10K radius of the CBD, we know our staff, we know all the agents as well. And that is also a crucial part of the equation that people underestimate. I think that ultimately a lot of what we do has to do with people and not actually property. So you find the right property, now what do you do? So that you've got to consider the vendor vendor motives. You've got to consider the agent's motives, because agents, as we follow them through the years, they tend to have the same way of transacting. So there are some agents who literally run everything to auction because they can't do a deal to save themselves, and there's other agents who we know that as soon as you put the right offer in front of them, they'll sell. So unless you have that understanding, the general buyer out there, they have no idea about this kind of stuff. So getting our clients prepared from that perspective is, I think, a real crucial part of what we do as well. And then obviously we've got to consider what is the market doing in sense of how much competition have we got to play with, and then either holding back, waiting for that auction to happen, or really pouncing as soon as we can.
Now, one final question. I mean, interest rates are going up.
Yeah.
Now, this would affect your clients. I mean, I'd imagine people in the market to buy a first home, it could be good for them because property prices will be falling, but it would also affect the clients who are looking for properties as an investment.
Yeah.
And so how do you handle that?
Well, the thing is that we don't get involved in the client's finances, right? First and foremost, because that is beyond our scope. We are not financial planners nor advisors. So we always recommend really doing their due diligence before they come to us with a pre-approval. We do not take on anybody who hasn't got pre-approval in place. And as buyer's agents, we're very conservative. We really only want to buy the best for our clients. So therefore, we also want them to be really comfortable and assured around being able to service the property in the long run. And all banks and brokers will calculate a number of percentage points increase in any way. The reality of it is that we are still in an environment with extremely low interest rates, compared to say 10 years ago. And so you've got to think of this as a long-term thing. If you're in it just for a short-term gain in and out, then this is not a place to be at the moment, right? With regards to investors, yes, interest rates are going up, but rental returns are also vastly increasing. There's a high demand for rental properties again, still. So I think they've just got to work out their yields and everything else. I mean, we do that for them anyway. But I think people need to look at it as what is their objective. If they're looking to get in and out within 5 years, I would say I wouldn't do it, because the cost of getting into the market and out of the market, they're really high. There's stamp duty still at the moment. I mean, that's changing now, but only up to a certain value. So people who buy a property over that value are still going to be lumped with stamp duty. There's the cost of agents, there's a cost of styling, etc., etc. If there is any capital growth to be had, it's going to be absorbed by all your costs. But ultimately, this is not, you don't go over, as we say in Holland, you don't go over one night's ice. You got to be, you got to really think about this. This can't be just an impulse purchase.
Well, Michelle, it's been fascinating talking to you, and thank you very much for your time.
My pleasure. Thank you so much.
And now let's talk to Rabobank economist Michael Every.
Well, Michael, the latest figures of the Chinese economy are, quite obvious. It's slowing down. The last figures I saw, it was growing at 4.5%, which is less than 5%. And the other question is, what happens with the impact of the US election? What impact will that have on China's economy?
Well, those are two very big questions. Let's start with the data. Our China analyst based in Utrecht, Theobé Mavison, he's been expecting that growth would come in below 5% this year. But we have to note the fact that, A, these Chinese numbers really are not worth paying a great deal of attention to. They're low quality data that's getting lower all the time. And as is the case in Western economies as well, they're increasingly politicized as well as of lower quality. So they're just indicative rather than anything you can hang your hat on. That said, there have been a dramatic flurry of press conferences over the past couple of weeks where various different institutions, from the People's Bank of China to the Ministry of Finance to other bodies, have all come out and said, we are serious about jumpstarting the economy this time. We're going to do whatever it takes. And then subsequently, after the stock market went through the roof, each press conference, has flattered to deceive. There's been almost nothing added that can really move the needle. It's marginal at best. What we believe is that why it helps at the margin, what it's more likely to do is mean that they now have the rhetorical get out of jail free card, that when we get the Q4 figures early in 2025, they will miraculously show that China did grow at 5%. So I don't know if you follow me there. Basically, the numbers aren't worth watching, but they're going to come up with a narrative that explains why all is well.
How is that possible?
How is that possible? They can come up with a narrative, or how is it
No,
possible they create numbers?
how is it possible that suddenly in the next quarter they'll go up again?
Well, as I said, now they've got the rhetorical backdrop to explain why that's happening, because all these officials have come out and said everything is going to be okay. You will be given the numbers and you will swallow them and you will like them. It's as simple as that. It's very, very easy statistically just to say that this particular contributing factor to GDP did better than everyone expected. And there's no independent, rigorous analysis that's going to go into China and say, well, actually, we've crossed the T's and dotted the I's and the number should be this. So everyone will just take that as the number. The very, very easy way, to be technical just for 60 seconds, is by something they call the GDP deflator, because you get nominal growth, which includes inflation, and then real growth, which excludes inflation. So if your inflation rate is high, when you remove that, your real growth rate is lower. That's how it normally works in the West. When you have negative inflation, as you sometimes get in China, if you subtract a negative, you push the real growth rate up.
Oh,
So all
right.
they're going to have to do is basically just make it more negative, and when you subtract that, the real growth will be positive. They've done that before. It's like falling off of a log to do that statistically, and I can assure you, 99.99% of people who look at the Chinese economy won't understand what they've done.
So really, they're just playing with numbers.
Well, they always have been. I mean, the truth of the matter is that the Chinese economy, as we've said repeatedly in previous chats, is massively underperforming in the sectors that the West wants it to perform in, and massively overperforming in the areas that the West doesn't want it to be performing in. So therefore, we say the economy is weak, not looking at the areas where actually it's incredibly strong.
Which raises the other question of what happens with the impact of the US election.
Therein lies the rub, because if we look at the issue here, it depends who you think is going to win. Now, the market was quite adamant up until recently that Harris was going to win. You could see that in terms of how things were priced. Our house view and our US strategist view, which I can tell you personally, I'm very happy to have agreed with all along, because one doesn't always have internal consistency in terms of what people think, even if banks write one thing, is that Trump was going to win. And now, in the last couple of days, markets have suddenly realized, goodness me, all these opinion polls saying it's a close race actually aren't, as usual, capturing the enthusiasm for Trump. And once again, the early voting, this time the early voting previously on election day, is showing a really big bump in Trump votes. Now, that doesn't mean it will last. Harris could still win. I'm not saying Trump is going to win, but the market is starting to price for the fact that he will. If he does, what is he saying? Massive tariffs on China. So if a Chinese economy, which is strong in terms of physical production, which it's exporting to everyone because it's weak in terms of domestic consumption, suddenly runs into a US that says, we ain't buying from you, and puts up tariffs, where does that leave China?
It's fascinating because The Economist 2 weeks ago had a cover where they were talking about what they called the Trumpification of US politics, where basically Harris's policies were quite similar to Trump's in terms of tax, in terms of immigration, but also in terms of tariffs.
They did, and it's, if I may say so, quite typical of The Economist. That's something I predicted 4 years ago. Not Harris, but Biden. So, congratulations to them. Slow hand cap. They've finally caught up with where more forward-looking people were an entire election cycle previous. It's true. The dynamic in that direction is very hard to resist because, as I think we have said to each other in previous conversations, if one large economy has a political economy which is based around production and not consumption, and the other one has an economy based around consumption, not production, ultimately you end up with a bilateral relationship where only one of them produces everything and only one of them consumes almost everything, which is impossible to sustain both economically, politically, and geopolitically, when one of them is the hegemon and the other one is the rising power that would quite like to push that hegemon out of Asia. So that was never, ever a sustainable paradigm. It was always, always going to collapse under geopolitical pressure. And lo and behold, even people who would like to free trade, like Harris, I think in her heart she would, realize there are no votes in it.
And so we can expect the same sort of thing, same sort of tariffs on China, whether Harris wins or Trump wins.
No, the important distinction here is if Harris wins, you'll keep pretty much the same backdrop you have now, although I'm certain that a lot of lobbyists will be pushing for her to try and walk away from it. Bloomberg, for example, had an editorial yesterday saying we really expect her to try and walk away from this Trump and Biden silliness, showing you where the money men would like things to go. If Trump gets in, this is not a repeat of Trump 1.0. Trump 2.0 is exponentially more radical in terms of what he's proposing, in terms of the mandate he would have to do it, and in terms of his ability to understand how Washington, D.C. works, so therefore to get it done. He's talking about something which would radically reshape the global trading and financial architecture, and that would affect everyone everywhere.
Because this time around, he would surround himself with people who would know how to get it done.
Correct. And he didn't previously understand the importance of it or the systemic nature of what he needed to do. And it's entirely possible he still doesn't. But I can assure you the people around him now do and will act on trying to achieve that as much as possible. And markets are just beginning to understand how destabilizing that will be for a great number of assets.
How would that affect other markets around the world?
Well, let's bring it home to Australia, shall we? It would be massively deflationary for China. Unless China responds with the kind of stimulus which it hasn't so far, it would mean that China would grow slower and slower and slower, and there would be lower and lower commodity prices, which is bad for Australia. At the same time, if the US is booming, it's very unlikely we can get lower interest rates in America. Ergo, if the RBA was brave enough to think they can do it, which at the moment they're not anyway, they wouldn't be able to without the Aussie dollar collapsing. So it's entirely possible you'd either get a collapse in the Aussie dollar, so inflation, or sustained high interest rates, tying yourself to the US cycle, which would mean extreme pain for your housing market. So there's really serious disruption implied across the board if Trump decides what's good for America is no longer what's good for everybody else. And let me be honest, that's entirely the case. Why should America run its economy to the benefit of everybody else? Why should it? It's a democracy.
So what would be the impact in Europe?
Well, just as bad. In Europe, you would see obviously the euro get a lot weaker, which at the margin is inflationary. At the same time, you would see companies that sell to America and they rely on it more than they do to China now, potentially lose that US market. That would be very deflationary again. And were America to follow through on threats to say, you now have to spend much more money on NATO or we're not going to have our troops in Europe and you're on your own, it would be inflationary in terms of the fiscal spending, but destabilizing in terms of the fact that they would have to spend a great deal more, which they're not used to doing within their fiscal rules. So all manner of sacred cows would be turned into burgers by Trump, were that to happen.
So we can expect a very difficult time ahead of us if Trump wins.
Except in America. Now, of course, you'll have internal dispute and conflict, and one hopes that can be minimized. But the likelihood is that whilst things could spiral out of control politically and economically, the balance of probabilities suggests actually America could boom, and it would be everyone else who has to deal with it. And again, like it or not, that's the reality. And I reiterate, the world for far too long has presumed that America wouldn't do that because it's bad for everybody else. But in a polarized economy where a great deal of Americans are finding life hard, why should they do less well just to prop up Australia or Europe or anybody else? I don't see how that's politically tenable.
Well, we'll watch that with great fascination, Michael.
We will indeed.
Well, thank you very much for your time.
Thank you.
So what's happening in the news? Well, Australia's headline inflation sank to its lowest level in more than 3 years in the September quarter, as lower energy prices and elevated interest rates eased price pressures in the economy. The annual consumer price index for the July-September period was 2.8%, or the lowest since the March quarter of 2021, the Australian Bureau of Statistics reported on Wednesday. That outcome compared with the 2.9% pace expected by economists and the 3.8% headline result for the June quarter. The underlying inflation rate, the trim mean that the Reserve Bank watches closely, came in at 3.5%. The result was in line with economists' forecast of 3.5% and the 3.9% pace in the June quarter. However, the ABS pointed out that annual services inflation, which is what the Reserve Bank of Australia is looking out for, was 4.6% in the September quarter, slightly higher than the June quarter, and has remained around high 4.5% for the past 12 months. Higher prices for rents, insurance, education and medical, dental and hospital services were the main contributors to services inflation. And Australia's Treasurer Jim Chalmers says there will be no cost of living free-for-all in the lead up to the election, promising that responsible economic management would be the defining feature of the Albanese Labor government. Dr. Chalmers rejected suggestions the government need to ramp up cost of living assistance to avoid a repeat of Labor's heavy loss in the Queensland election on Saturday. Ousted Queensland Premier Stephen Miles tried to win over voters with costly handouts like 50-cent public transport fares and free school lunches, but failed to convince them he had a coherent economic plan. Dr. Chalmers said while there would be extra cost of living assistance unveiled before the federal election, due by May next year, the emphasis would remain on responsible economic management such as minimising debt and deficit and trying to force down inflation. This election was never going to be, from our side, a free-for-all of public spending. It wasn't going to be before Saturday's outcome, and it's not going to be after Saturday's outcome, he said. Dr. Chalmers said the government understood people were still doing it tough and often expressed that at the ballot box, which is their right. And so we will go through the lessons of Saturday with that in mind, he said. Everything we will do will be through the prism of what's responsible, what is affordable, and what will make a meaningful difference to people doing it tough. Dr. Chalmers pointed out that the Albanese government was not in as parlous a position as its Queensland state counterpart was. Theirs was a government that had been there for almost a decade. Ours is a government in its first term, he said. The prevailing view in federal Labor was not to indulge in a spinthon like Mr Miles, but to craft one or two measures with a real cut-through like the 50-cent bus fares. And the Morrison government's delays procuring COVID-19 vaccines cost lives and delivered a $31 billion hit to the economy, while Australians have lost trust in government and that the health system is still struggling. The first wide-ranging inquiry into the national response to the virus has found. The report released on Tuesday afternoon revealed more than $210 billion in federal government stimulus aimed at protecting the economy amplified the inflation pressures still working their way through the country. And Myer's merger with a big portfolio of clothing brands owned by Solomon Lew's Premier Investments will let it expand its lucrative loyalty program to younger shoppers and get better deals from its suppliers. It's the biggest shake-up of the retailer since it returned to the ASX in 2009. The deal, announced on Tuesday, will add 719 stores to Myer and a portfolio of labels that range from those appealing to young adults in JJ's and Dotty to older women with Jackie E. Those chains, known as Premier's apparel brands, also include Just Jeans and Portmans. Mr Lew will personally control about 27% of the bigger Myer group if the transaction is approved by shareholders, and Premier will focus on growing its Peter Alexander sleepwear and Smiggle stationery brands. And Australia's major accounting firms are raking in tens of millions of dollars in remuneration fees amid a surge in insolvencies as rising costs, dwindling revenue, and a crackdown on unpaid tax lead businesses into financial strife. Insolvency appointments have soared 40% in the 2024 financial year to a record high of 11,049, surpassing the peak of the global financial crisis, with the latest September quarter 45% above the same period in 2023. BDO Business Restructuring National Leader Duncan Clubb said the process outsourced the business and its liabilities to a third party who had to ensure they would not lose money if it was a viable business. He said fees started at $50,000 and could easily run into the millions for more complex jobs. It's a scalable business model with accounting, and you charge by the hour, so it can get expensive very quickly. As examples, Rex and its subsidiaries are shaping up as the most costly voluntary administration in several years, with EY estimating its remuneration will be between $6.4 million and $7.9 million, depending on when a buyer is found. Hall Chadwick, which oversaw the collapse of budget carrier Bonza and later its wind-up, collected $3.52 million. Godfrey's, a seller of vacuum cleaners for almost 100 years until it collapsed in January and closed for good in May, resulted in a claim by administrator PwC for $3.54 million, while the voluntary administration of Booktopia is estimated to have cost up to $900,000 by McGrath-Nicol before DigiDirect acquired it. And almost 1 in 6 businesses are rated at a high risk of collapsing thanks to high interest rates, cost of living, and the lingering effects of the COVID-19 pandemic, which continues to put pressure on the food and beverage services sector. Credit Reporting Bureau Creditor Watch's latest industry risk ratings confirm hospitality is the most under pressure, with a mind-boggling 16.2% of businesses rated at a high or very high risk of failure. Administrative and support services are next at 7.2%, and arts and recreation services are at a 7% high or very high risk of collapse. Creditor Watch said the current higher interest rate regime increased input costs, energy price rises, reduced visitation in CBD locations, and lower consumer spending were negatively affecting discretionary spending. And retailer Mosaic Brands, which owns some of Australia's iconic apparel brands like Rivers, Katie's and Miller's, has collapsed, and KPMG has been appointed as a receiver. Also appointed as voluntary administrator is FTI Consulting, working on the receivership for KPMG on behalf of lender Hilco. Owed between 20 million and 40 million is David Hardy, Gail Dickerson, Ryan Eagle and Amanda Cunningworth. Rival firm Cordamentha had also been positioning for the receivership role. KPMG said in a statement released to the market that the appointment of the external administrators by the board follows what has been a difficult period for the business, which has faced a number of structural challenges and disruptions relating to suppliers and inventory management. The Mosaic Group and the management team, led by Chief Executive Erica Berchtold, former boss of the Iconic, see this as a necessary process to reset and a pathway to accelerate its plans to focus on its core brands of Katie's, Miller's, Noni B and Rivers, to resolve legacy issues and right-size the store network to ensure the ongoing success of the business, it said. It comes as apparel chains come under increasing pressure and a result of the weak economic environment and cost of living crisis are aggressively discounting stock. Ms. Berchtold said the priority was to rationalise and put plans in place to focus on the core brands. Mosaic operates 9 retail clothing brands with about 700 stores in Australia and New Zealand, as well as through online platforms. It flagged it would report an operating earnings before interest, tax, depreciation and amortisation loss of between 5 million and 10 million, and an earnings before interest and tax loss of between 15 million and 20 million dollars for the year to June. It also expected a loss for the first half of this financial year. The disruption of migrating to a fully integrated logistics supply chain and distribution system with a newly appointed global partner has hurt the group. And Prime Minister Anthony Albanese has defended receiving dozens of free Qantas upgrades and his relationship with former Qantas Chief Executive Alan Joyce. 9 newspapers report that Mr Albanese received at least 22 free upgrades over more than a decade. Mr Albanese told reporters all his upgrades had been declared. From time to time, members of Parliament receive upgrades. What's important is that they're declared. All of mine have been declared, he said. I note that a range of them go back a long period of time, and they've all been declared as appropriate. Joe Aston's book reportedly claims the Prime Minister dealt directly with Alan Joyce on several occasions, and that he asked Mr Joyce to make his son Nathan a member of the Chairman's Lounge in 2022, after the federal election. Mr Albanese's relationship with the former Qantas boss has been under scrutiny since the government made a decision not to allow Qatar Airways more flights into Australia. He said he had the same relationship with Mr Joyce as he had with the former Virgin CEO John Borghetti. When asked whether politicians should stop taking airline upgrades, Mr Albanese said, "It's a matter for them." Opposition Transport Minister Bridget McKenzie said the Prime Minister had more questions to answer. An incoming Queensland Premier, David Crisafulli, who is now the highest-ranking Conservative leader in Australia, is expected to hold firm to his repeated rejection of his federal counterpart's nuclear energy push. Mr Crisafulli will be sworn in as Premier after securing a comfortable mandate at the weekend's election, with his ascension compounding an awkward schism in the energy policies of the state and federal party branches, establishing a nuclear energy grid across the country, which includes 2 nuclear plants in Queensland, will form federal opposition leader Peter Dutton's headline policy at the next national poll, due by May. Mr Dutton joined Mr Crisafulli in the opening days of the state election campaign, when they were peppered with questions about the differences on nuclear energy. 2 of the proposed sites, Tarong and Callide, are in Queensland, but Mr Crisafulli has said he would not repeal the state's nuclear ban. Friends can have differences of opinion, that's healthy, the now Premier-elect said at the time. The Queensland-based federal leader will be eager to shore up Coalition's dominance in the Sunshine State, where it holds 70% of the seats, but it was unlikely to secure the support for nuclear from the incoming Premier. Nationals leader David Littleproud, another Queensland figure, has in the past been infuriated by the state branch's refusal to fall in behind the energy policy, and on Sunday again said he expected all states to back nuclear if the coalition forms government. We expect that if the Australian people give us that mandate, the state premiers around the country respect that mandate, and we get on with the job, he told the ABC on Sunday. And a super fund for butchers and meat industry workers will emerge as the largest shareholder in fruit and vegetable processor SPC when it relists on the ASX in December. The Butchers Super Fund was called the Australian Meat Industry Super Trust until a rebrand in late 2023 to Australian Food Super. It will hold 16.5% of the enlarged SPC Global when it relists on the ASX. The Butchers Super Fund has almost 68,000 members and $3.2 billion. SPC Chairman Hussein Rifa's private entity, Hajer Proprietary Limited, will hold 12% of the newly listed SPC Global upon completion, while private equity group, the Eights, will hold 15.2%. Shareholders of the original juice company, chaired by former Victorian Premier Jeff Kennett, will vote on November 22nd on a proposed transaction where the much larger SPC business will join forces with the original juice company and the infant formula business Nature One Dairy. Will have combined annual revenue of $400 million in 2024-25. And the cyber attacker in Optus's 2022 data breach had a high degree of knowledge of its confidential systems, the telco has claimed, as it seeks to counter allegations from the communications regulator that the hack was unsophisticated. Optus is being sued in the federal court by the communications regulator, alleging it did not protect customers' confidential information before being struck by a cyber attack on September 17, 2022 at 8:17 a.m. The attack lasted until about 3:45 a.m. on September the 20th. The Australian Communications and Media Authority filed proceedings in May related to the September 2022 cyber attack, alleging the Singaporean-owned company had failed to protect the personal information of its customers. In its statement of claim filed last week, ACMA alleges the hack was not a highly sophisticated cyber attack and did not require advanced skills, and that it was carried out through a process of trial and error. ACMA alleges that a publicly accessible internet domain, known as a target domain, was readily identifiable by examining Optus web or mobile sites. From the 12th of July 2018, a post on the website github.com identified the target domain and code to retrieve data using one of the target API's application programming interfaces, ACMA said. APIs allow computer programs to communicate with one another. The cyber attack was able to get customers' personal information due to a coding error in September 2018 that did not adequately protect the target domain, ACMA claims. ACMA claims Optus's actions breach the Australian Telecommunications Act on at least 3.6 million occasions. Each contravention carries a maximum penalty of $250,000. But Optus has denied ACMA's allegations, arguing that it was a target of a criminal attack that deliberately targeted its systems. The cyber attacker commenced the cyber attack with a high degree of knowledge of Optus's systems. Optus admits that its mobile business collected personal information from its customers, but denied that it held information such as driver's license numbers, Medicare card number, birth certificate details, and names and addresses. The personal information was stored in another entity in the Optus group of companies accessible to and by Optus Mobile for authorised purposes, the company said. Optus has already lost a separate court battle after trying to stop information in a report it commissioned from consultants Deloitte into the 2022 cyber attack from being released as part of a class action proceedings brought by Slater and Gordon on behalf of the telco group's customers. In May, the federal court dismissed an appeal brought by the telecommunications group to try to keep the Deloitte report confidential. While Deloitte's forensic investigation report on the causes of the cyber attack in September 2022 will not be publicly released, some of the information in the report could become public through the class action proceedings. And that's it for this week. And next week I'll be talking to Amsterdam-based Stephanie Walker, a product owner at NMS Productions, who uses the Noah Coach team, which provides an unparalleled AI-driven coaching platform designed to provide cost-effective, time-saving and highly personalised support to individuals dealing with workplace stress and anxiety. And I'll be talking to economist Saul Eslake about Australia's latest inflation figures. For the most successful access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, on X, formerly known as Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or editorial, email me. Wishing you all a safe and healthy week and looking forward to bringing Talking Business next week.